Welcome to today's Explainer. We're going to be diving into something truly fascinating, decoding the mechanics behind a massive trillion-dollar global system, Islamic finance. Now, this is a system that operates on a totally different set of financial principles than the conventional banking models that, most of us use every single day. Whether you're a financial pro or you're just a curious learner, pulling back the curtain on this alternative architecture offers us some absolutely incredible insights. We get to see exactly how capital, risk, and the real economy can actually interact without relying on standard interest. It's a real paradigm shift, so let's get into it.
Right off the bat, we're faced with this fascinating paradox. It completely challenges the very foundation of conventional banking. I mean, think about it. In traditional finance, the time value of money, basically charging interest on a cash loan, is the absolute bedrock of how banks make a profit. So, you might be wondering, if you completely remove that mechanism, how does capital actually grow? How do these banks survive, let alone thrive on such a massive global scale?
Well, to answer that exact question, here's our agenda for today. First, we'll cover the foundations of Islamic finance. Second, the mechanics of Islamic contracts. Third, sukuk, the Islamic bond. Fourth, corporate Sharia screening. And finally, number 5, accounting and global standards.
All right, part 1, Foundations of Islamic Finance. Everything in this entire system stems from a few very strict, non-negotiable rules.
The absolute core, the bedrock of Islamic finance, is the prohibition of riba. In plain English, this basically means money itself cannot generate money. Under Sharia principles, you literally cannot charge a guaranteed fee just for handing over cash. Think about a standard credit card or a personal loan, right? You're basically paying for the privilege of holding that cash. Well, in Islamic finance, that is completely banned. Instead, any financial reward absolutely must be directly linked to real business performance. You've got to put some skin in the game. To earn a return, you have to take on actual business risk.
Following closely behind that is the concept of GAR, which translates to the prohibition of excessive uncertainty, speculation, or gambling. Basically, for any transaction to be considered valid, the underlying asset, the exact price, and the delivery schedule have to be clearly identified right up front. You can't sell something you don't actually own, and you definitely can't build those complex, highly speculative derivatives where the underlying value is just a total mystery. This principle is there for a very specific reason. It's designed to prevent market manipulation and to protect everyone involved from getting exploited by hidden toxic risks.
And that brings us to this brilliantly simple framework. Every single transaction has to be anchored in the real economy. You just cannot have a financing transaction without an underlying commodity or a tangible asset. Risks and rewards, they must be genuinely shared between the parties. The documentation has to show a real asset transfer, not just a bunch of people shifting debt around on paper. Plus, capital simply cannot flow into non-permissible industries, so things like alcohol, gambling, or even conventional interest-based financial services are totally off the table.
Okay, moving right along to Section 2, Mechanics of Islamic Contracts. Let's look at how these theories actually play out in the real world. So, the crucial takeaway here is the contrast. Let's say a business needs to buy some equipment worth $25,000. Now, a conventional bank is just going to hand over $25,000 in cash and then charge interest on that principal amount. Simple enough. But an Islamic bank, using what's called a murabaha contract, they do something fundamentally different. The bank actually goes out and purchases the equipment directly from the supplier. They take legal ownership of it. This means the bank holds the physical risk if something gets destroyed or goes wrong before delivery. Then, the bank turns around and sells that exact equipment to the business for, let's say, $28,000 on deferred payment terms. That extra $3,000? That's a transparent, pre-agreed profit margin. It is not an interest charge on a cash loan. The legal and structural reality here is totally different. It's a genuine trade transaction involving a real, physical asset.
Next up, we have Musharaka. This is basically a profit-sharing partnership. There's a great example from the sources to illustrate this. Imagine a guy named Hassan provides $40,000 for a new trading venture, and Bilal is the one managing the actual business. They agree up front that Hassan gets 60% of the profits, and Bilal gets 40% for his labor and management. So, if the venture makes $10,000, boom, they split it 60-40 just like they agreed. But here is the real kicker. Let's say the venture actually loses $5,000, and it wasn't because Bilal was negligent. In that case, Hassan absorbs that entire $5,000 financial loss against his capital. Bilal, on the other hand, essentially loses the sweat equity and the time he invested. It's a mathematically precise way to make absolutely sure that financial reward is perfectly synced up with shared risk. Now, similarly, we have ijara. This operates a lot like a traditional leasing or landlord arrangement that you might be familiar with. The bank takes ownership and, importantly, takes on all the associated physical risks of a property before leasing it out to the customer. The bank then earns its lawful profit through rental fees, and both the duration and the exact amount are set totally in advance. Because the bank actually owns the asset during the lease, they maintain that strict non-negotiable requirement for asset-backed financing, and they actively carry the risk of ownership.
All right, Section 3, Sukuk, the Islamic bond. We've talked about everyday contracts, but how in the world do we scale this up to fund massive global infrastructure?
What's really fascinating here is a crucial distinction that honestly gets missed in the media all the time. Sukuk are almost always reported as Islamic bonds, but structurally speaking, they are not debt obligations. When an investor buys a conventional bond, they're essentially buying a promise to repay a debt with interest, right? It's an IOU. But when an investor buys a sukuk, they're actually buying a proportional piece of ownership in a tangible, productive asset, a specific project or a joint venture. You own a piece of the pie, not a piece of debt.
Let's break down the life cycle of a musharaka sukuk in action to see how this works. Step 1. The originator sets up a special purpose vehicle, or an SPV, to raise funds from investors. Step 2. That SPV acts as a trustee. It enters into a joint venture with the originator, injecting those investor funds into a real physical project. Step 3. As that project actually generates profits or losses, those are distributed back to the sukuk holders. And finally, Step 4. At maturity, the originator typically acquires the business units back, which provides the funds for redemption. It is just an incredibly elegant way to raise massive, large-scale capital while strictly avoiding that prohibition on interest.
Moving to Section 4, Corporate Sharia Screening. Let's shift gears for a second from debt alternatives to the actual stock market.
For equity investments to be permissible, companies have to undergo some really strict screening. And the first major hurdle is the business activity screen. This is highly quantitative. A company's revenue from non-permissible activities, so again, things like interest-based finance, gambling, or alcohol, that revenue must stay strictly below 5% of its total operating income. If they cross that 5% line, even by a fraction, that stock is completely off limits to an Islamic investor. No exceptions.
But it doesn't stop at revenue. There are also these rigorous financial ratio limits. The magic number here is 33%. A company has to maintain a total debt to average market cap ratio of less than 33%. And that exact same 33% limit applies to cash and interest-bearing debts compared to market cap, as well as account receivables. The underlying logic here is super important. It ensures that the investor is buying into a real, productive, healthy business, rather than some highly leveraged shell company that's just drowning in debt. It actually acts as this amazing built-in safeguard against market bubbles that are caused by overborrowing.
Which brings us to our final part, Section 5, Accounting and Global Standards.
Now, trying to integrate this highly specific, asset-backed system into the conventional world of global finance, it creates some genuinely fascinating regulatory friction. There is a deep conceptual clash here between conventional international financial reporting standards, what we call IFRS, and Islamic accounting principles. For example, IFRS operates heavily on a substance over form basis, meaning if a lease effectively transfers all the risks and rewards of an asset to the user, IFRS just treats it as a finance lease. It basically treats it like a loan. But Islamic accounting dictates that the legal form and the substance absolutely must align perfectly. So, in some jurisdictions, an ijara lease has to be treated strictly as an operating lease, because the bank technically still retains legal ownership and the risks. On top of that, while IFRS completely relies on the time value of money for calculating present value, applying that concept is deeply disputed in Islamic standard setting. It's a real clash of paradigms.
There is a quote from the Institute of Chartered Accountants of Pakistan that just hits the nail on the head here. It brilliantly illustrates the strict boundaries required to maintain compliance. It basically pushes back against that conventional accounting instinct to just lump an Islamic murabaha or an ijara in with standard conventional loans just because their economic return curves look somewhat similar. At the end of the day, if the legal form isn't a genuine trade, it's just not valid, period.
Because of all these huge structural differences, organizations like the Islamic Financial Services Board, or the IFSB, are absolutely vital. They're out there actively working to develop global standards, trying to harmonize these incredibly complex regulatory and accounting frameworks. Their work ensures that whether a sukuk is being issued in Malaysia or an ijara contract is getting signed in London, there is a consistent, transparent framework that protects investors and maintains that strict Sharia compliance across borders.
So, what does this all mean for us? Understanding all these mechanics leaves us with a really compelling question.
The World Economic Forum is currently reporting an annual global infrastructure financing gap of $1 trillion. We are so heavily reliant on conventional debt to build our future right now. But as we've explored today, Islamic finance offers a very different path, an asset-backed, risk-sharing model that is anchored entirely in the real economy. Could moving away from just shifting debt around and moving toward genuine risk-sharing be the key to more stable global economic growth? It is absolutely a question worth exploring. Hopefully this explainer has given you the foundational tools to start thinking about it. Thank you so much for joining me today.